Wow, Lulu, I think you getting into AI is cool, but robotics, isn't that just a little too far?
Time to buy, Lulu.
Are you sure it's safe?
Of course it is, Guru.
Evening garage. It's Thursday, January 15th. The block is hot. It's me, Avatar John, and I've got the wheel tonight. Before you scroll, lock in for 10 seconds. Mortgage rates just hit a 3-year low. The S&P 500 just hit 7,000 for the first time ever. AI infrastructure is accelerating. Bond volatility just spiked. And crypto didn't flinch. That combination does not show up when everything is healthy. It shows up when the system is getting ready. Now let's break this down like adults. First, mortgage rates. Mortgage rates dropping is not a victory lap. Rates don't fall because the economy is crushing it. They fall because the bond market sees stress coming and moves early. Mortgage rates don't follow headlines. They follow treasury yields. And today yields eased a bit, while uncertainty underneath them went up. That's not bullish. That's the suspension getting softened because the road ahead isn't smooth. Now let's talk about bonds, and this is where TV loses people. You've all heard some guy on CNBC say, yeah, the MOVE index is up. Then he keeps talking like everyone knows what that means. So here's the real definition first. The MOVE index measures the expected volatility in US Treasury bonds over the next month. It's built from bond options, real money hedging future interest rate swings. Low move means rates are predictable. High move means the cost of money is uncertain. That's the textbook version. Now here's the garage translation, the one that actually matters. The MOVE index is insurance on the bond market. When nobody's worried, insurance is cheap and ignored. When uncertainty shows up, everyone starts buying protection. So when the MOVE index rises, it means the adults in the room are getting cautious, and bonds are where the adults are. Banks, pensions, governments, mortgages, everything sits on that foundation. So today you had something important happen. Mortgage rates were falling and the system trying to stay smooth. At the same time, the MOVE index was rising, the system buying insurance. That's not panic, that's preparation. Car version, you're still driving fast. You're smiling at the passenger, but your hands just tightened on the steering wheel. Now layer in the stock market. The S&P hitting 7,000 sounds incredible. Headlines celebrate, everyone claps. But here's the truth. The faster you're going, the less room you have for mistakes. When markets are at record highs, everything has to go right. And today, bonds were quietly saying things are getting tight. That's why this day matters. Strong AI fundamentals, stocks at all-time highs, bond insurance getting more expensive, mortgage rates easing early. That's not confusion. That's transition. And now, here's the part that matters to this garage. Crypto didn't panic today. It didn't rip either. It stayed calm. That tells you money isn't leaving, it's waiting. Let's talk about why stocks ripped today, even while bonds were nervous, because this is where the whole story actually comes together. First, Taiwan, specifically Taiwan Semiconductor Manufacturing Company, TSMC. When tariffs on Taiwanese goods were cut and Taiwan immediately pledged massive chip investment and credit guarantees, that wasn't politics. That was supply chain emergency management. TSMC isn't just another tech company. They are the factory that makes the brains for AI. If AI is the engine of this economy, TSMC is the machine shop. So lowering tariffs and locking in investment wasn't about growth. It was about avoiding a stall. AI demand is exploding. Factories take years to build. Chips don't scale overnight. That deal said very clearly, we are not risking delays. Now here's the part most people missed. That chip deal hit the tape the same day as monster US economic data. Jobless claims beat expectations. Continuing claims beat. Factory data from New York and Philly came in hot, way above estimates. Translation for a normal person, people are still working, factories are still busy. The economy is not slowing down. That's why stocks pump. Strong data plus AI confirmation equals a risk on reaction. Traders saw growth holding up, AI build out accelerating, and no immediate recession, so they bought stocks. That's the TradFi pump. But here's the part the garage needs to understand. Strong economic data is a double-edged sword. Yes, it supports stocks in the short term, but it also means no rate cuts, higher rates for longer, and more pressure underneath the system. That's why bonds didn't celebrate. Bonds don't trade headlines, they trade consequences. So while stocks were cheering, bonds were quietly tightening their grip because when growth stays strong, the Fed can't bail anyone out. And that's why you saw this strange mix today. Stocks ripping, bond volatility rising, mortgage rates easing early, crypto staying calm. That's not contradiction. That's different layers of the system reacting to the same reality. The stock market trades today. The bond market trades the future. And the bond market heard that data and said, growth is strong, which means money stays expensive and things get tighter. So what did the system do? It propped up housing early. It locked in chip supply. It let stocks run. And it bought insurance and bonds. That's a coordinated response. Now, here's why this matters for crypto. Strong data and accelerating AI don't hurt crypto immediately. They delay the trigger. Crypto doesn't front run good news. Crypto front runs stress. And right now, stress is building quietly. Infrastructure pressure is rising. Power demand is climbing. Capital costs are going up. And there's no policy relief coming to smooth it out. That's why crypto didn't chase stocks today. It waited. And that's also why today's crypto headlines looked confusing if you weren't paying attention. Crypto stocks sold off on regulatory delays. Crypto itself stayed calm. Banks started talking about tokenization and stable coins. Institutions quietly expanded regulated crypto products. That's not chaos, that's a power struggle. Old systems protecting control, new rails getting built anyway. And when you zoom out, the picture is clear. This market isn't trading headlines. It's positioning for who controls the infrastructure when things get expensive. That's the phase we're in. And that's exactly where the next move in crypto comes from. Right? Not hype, not price, but pressure finally showing up. That's the setup. XRP Army, here we go. Let's tighten this up and explain what's really happening. Supply shock doesn't mean price goes up tomorrow. It means inventory is quietly disappearing, often without the price reacting right away. If you remember the car chip shortage, this will click. Prices didn't jump the moment chips ran out. They stayed weirdly flat for a while. Why? Because a lot of cars were still being sold off the lot, dealer to dealer, fleet to fleet, not through public listings. That's exactly what's happening here. Let's start with XRP. XRP has a total supply of about 100 billion tokens, but that number is almost meaningless. What matters is usable supply and what's actually available on exchanges for anyone to buy. Right now, exchanges hold about 1.6 billion XRP. That's only about 2% of the circulating supply. A year ago, exchanges held around 4 billion XRP. So in 12 months, roughly 2.4 billion XRP left exchanges. That's a 57% drop in visible inventory. Now, here's the key part. That XRP didn't vanish. It didn't get burned. It moved off exchanges. And a lot of it moved OTC, over the counter. OTC just means big buyers and sellers transact directly without hitting the public order books. No slippage, no big candles, no price spikes. Think of it like selling cars in bulk to rental fleets instead of putting them on the lot. The cars are gone, but the sticker price on the dealership window doesn't change yet. That's why price can stay flat while supply disappears. Big holders added about 180 million XRP just since early January. ETF-style products locked up close to 800 million XRP, and large transfers are avoiding exchanges. That's not retail selling, that's inventory being quietly absorbed. Now here's where people get tripped up. Low supply by itself doesn't cause a rally. We've seen this before. Back in 2018, XRP also had low exchange supply and price went nowhere for a long time. Why? Because everything was happening OTC. No urgency, no forced buying, no panic. That's exactly where we are right now. Leverage is quiet, speculators are calm, and transactions are happening off screen. That's not bearish, that's pre-shortage behavior. Now bring Bitcoin into the picture because the same thing is happening there, just at a bigger scale. Right now, exchanges hold about 2.6 million Bitcoin. That's roughly 13% of the total circulating supply. In just the last few days, spot ETFs absorbed about $1.7 billion of Bitcoin, roughly 20,000 Bitcoin, and whales added around 30,000 Bitcoin. So nearly 50,000 Bitcoin left the market in about a week. Miners only produce about 450 Bitcoin per day. That's more than 100 days of new supply absorbed almost instantly. And again, a lot of this is happening outside the exchanges. ETFs, custody desks, OTC routing. So price doesn't react right away because the buying isn't screaming through the order book. It's being handled quietly in the background. That's the same car shortage dynamic. Prices don't spike when inventory starts thinning. They spike when dealers suddenly realize they don't have enough cars if demand picks up. That's the moment supply shock actually hits. So zoom out. Bitcoin is the reserve asset. XRP is the rail. Both are seeing inventory leave exchanges faster than it's being replaced. Both are seeing activity shift OTC. This is not the moment where price goes crazy. This is the moment where the system quietly realizes that if demand increases even a little, there isn't enough left on the shelf. And once that realization hits, price doesn't move because of hype. It moves because there's nothing left to sell at current levels. That's supply shock. That's the phase we're in. And that's why price can stay calm right up until it does. Quick pivot before we shut this down, because this is what a lot of you are really here for. XXX checked in tonight from the back room at Red Rock Casino. No noise, no crowd, just screens and discipline. He walks in with 35 SOL. That's the bankroll. That's the rule. One screen is BullX, the other is Dex Screener. No names getting chased, no narratives getting married, just clean setups and execution. First play he touches is game-centric, ticker GCVC on Solana. Fresh launch, real liquidity, holder count climbing fast without sketchy wallet behavior. He takes a starter position, lets it move, trims into strength, no greed. Second rotation is on Big Don on Binance Smart Chain. Liquidity was real, volume was heavy, order book wasn't fake. He doesn't chase the top, he waits for the pullback, takes profit into strength. Third touch is a quick Solana momentum scalp. Nothing fancy, no long hold, just flow. Every trade follows the same checklist: liquidity depth, volume versus market cap, holder growth, clean contract behavior. If one of those breaks, he's out. 2 trims, 1 clean exit, no hero trades. When he shuts the screens down, the math is simple. He walked in with 35 SOL. He walked out with 77 SOL. That's not luck, that's process. Now let me be crystal clear before anyone gets cute. None of this is financial advice. If you don't understand risk, you will lose your money. Early stage tokens are volatile, unforgiving, and fast. XXX survives because he cuts fast and respects liquidity. If you don't, the market will teach you the hard way. Quick house note before we go. Lulu is off tonight. We've got a new addition at the ranch and she's busy giving the new girl the full tour. Priorities matter. And one more thing, go check out the new website, gurucryptogarage.guru. Totally free, no paywalls. Tell us what you think. Real John has some real fire going into this next run. As always, engine's hot, discipline first, let it rip.